bonds right now are return-free risk. I tend to like to split my portfolio up into three main pillars. So when they tap out taxing, then they move to borrowing. When they tap out borrowing, then they move to printing. When you look at valuations today versus 99, we're in a different monetary environment.
Okay, guys, so today we have Joe Brown from Heresy Financial. And today we will talk about the state of the current economy. We will talk about what's happening right now in the commodity sector, gold, silver, and we will talk about portfolio structure. So, Joe, thank you so much for being here.
Yeah, my pleasure. Thanks for having me.
Thank you very much, Joe. So, we have so much going on with the US economy. We just recently got the economic data. And what's your take on what's happening right now with all the revisions and everything?
Yeah, so I mean, it is true that there have been big problems with the jobs data for a long time. I mean, for a number of years, I've been pointing that out on my YouTube channel between the differences, like the discrepancies in different job reports. For instance, the main one that most, news outlets look at and policymakers use is called the Establishment Survey. And so they go to what businesses and they say, how many employees do you have? They go to the next business. How many employees do you have? And so let's say they go to McDonald's and Taco Bell and Burger King and Wendy's and KFC. And all of five of these companies say, oh yeah, this month we've, on net we've hired, this many people. So then the establishment survey says, oh look, we added this many new jobs to the economy. Well, there's another survey called the household survey. And the household survey goes to people and they say, okay, are you working? Are you not working? If you are working, how many jobs do you have? Are they full-time or are they part-time? And and oftentimes when the establishment survey shows job increases, the household survey will show job losses. And the reason why is because people will go get a job at McDonald's and at KFC and sometimes a third job at another fast food place. And I'm not just picking on fast food here. I'm just, saying whether it's Walmart or, whatever the company is, they'll have multiple part-time jobs. And so the establishment survey counts that as, if one person has three jobs, they say, oh, yeah, we added three new jobs to the economy. But really, that's just one person trying to make ends meet so they have multiple part-time jobs. That's not a sign of economic growth. That's actually not a very good sign, a sign of economic hardship. And and so that's one of the big problems. Another problem is counting government jobs. So they'll just look at non-farm payrolls, but government jobs are included in that. And for the most part, any government job is going to be a net drain on economic growth because you have to take money from the productive private sector and pay that money to somebody who is in by definition a non-productive role, something that is not adding to GDP. And so that's a big problem with it as well. And then the biggest problem that people are looking at right now is the issues with the data just being accurate. So they have to make a bunch of estimates when people don't respond to the surveys. And then later, once they get more accurate data, they make revisions. And the problem is the revisions are always downward. Like I've rarely ever seen revisions to the upside, meaning they're like, oh, we counted this many jobs, but in reality, once we got better data, we actually added more jobs. Usually it's to the downside. So that means there's some bias in the models used to estimate this job data to bias it towards more jobs rather than fewer. So there's been a lot of problems with this for a long time. I I don't know. I don't know whether it will get better. It's unclear who's going to be taking over, how they're going to be making changes, how they're going to be collecting the data going forward. It could get worse. But yeah, there have been some big problems with this data for a while.
Thanks for that, Joe. And with the Fed and with Powell, Trump putting pressure on him, what's your take on this whole mess, really, of what's happening right now?
They're kind of a similar situation. There are a lot of problems with having a central bank that determines monetary policy. We all agree, like most economists agree, that price controls are always destructive. Like if you have a central board or a committee or an agency just decide the price of bread or decide the price of gas or decide the price of anything, you're going to result in a misallocation of resources because either that price is going to be set too low and then that will result in shortages, or the price will be set too high and that will mean people cannot get it when they should be able to get it. It will result in oversupply. Um, and Also, prices are dynamic to supply and demand and wants and needs of consumers and producers. And if you set the price, you cannot respond to those until it's far too late once you see the data. Um, and Everybody accepts this is true until you get to money. When it comes to money, which is funny because money is one half of every transaction. But when it comes to money, economists just say, oh, yeah, well, we should be setting the price of money because that's what interest rates are. It's the cost of money, cost of capital. And they just, don't even look twice at it. Oh, yeah, we should have a committee that just decides what the cost of capital is. When that is one side, that is the input to literally every transaction, production and consumption that happens across the entire economy. So, what you end up getting is a massive distortion, either again, undersupply or oversupply, too little or too much, because it cannot respond dynamically to market needs. Um, Now, one thing that I think is like if we're gonna, if we're throwing out ideal and we're just saying, okay, how is it right now and what is the, potential for the future? Right now, the way that the people that decide this, it's the Federal Reserve. They are quasi-public and quasi-private. So there are some people in leadership at the Federal Reserve that are put there by private banks. There's some people in leadership that are appointed by the federal government, by the president, nominated by the president, put in place by Congress. And both the control structure and the ownership structure in terms of the profits. Some of the profits the Fed makes, it sends out to its member banks. The rest of the profits it sends back to the federal government. So both in control and in profits, the ownership structure of the Federal Reserve is part private, part public. Um, the decisions that they make, though, are, everybody always says the Fed is independent, and that's because they are not directly controlled by a branch of the government. They're not under the judicial branch, they're not under the executive branch, they're not under the legislative branch. They're apart from that, and that the intent of that, and sometimes the result of that is somewhat a good thing because it means that they don't have to worry about the next election. They don't have to worry about a lot of the political pressures. They don't have a boss in one of the branches of the government that they have to please, and so they're making decisions that allegedly they feel are the best monetary policy decisions. Now, many times they do make decisions that people look at and say, well, that was outright political, whether it's lowering interest rates directly into an election when inflation is high, and then later reported inflation is lower, and they're not reducing interest rates anymore. A lot of people look at that and say that's politically motivated. The other side says, well, I mean, look at the fiscal situation we're in right now. We're spending more, we're borrowing more, we're receiving less tax revenue. We are in a debt spiral, so lowering interest rates right now is only going to make that fiscal problem worse. Um, and that's a valid point. So there are some benefits that we get by keeping the Federal Reserve as independent as it is. Um, Be careful what you wish for because if you're looking at the decisions they're making and saying they're making incorrect decisions, well, there's a chance that more control over the Federal Reserve by the federal government happens underneath the executive branch, which means there's um, a lot more temptation or potential for the abuse of monetary policy to have short-term benefits that have those long-term costs and consequences. And we already see somebody who's resigning from the Federal Reserve board, going to be replaced by somebody that is going to be more keen to lower interest rates. We see a lot of talk about who will be the next chairman of the Federal Reserve to replace Powell. We see talk of maybe trying to fire him for misappropriation of funds for the renovations of one of the Federal Reserve buildings. And so there's a lot of political pressure that is trying to bring more control to say, hey, we want you to follow along with what the executive branch wants you to do. And if you think that that's a good idea because you think the executive branch has a better idea of what should happen with monetary policy than the Federal Reserve does, just be careful because if a system being successful depends on having the right person in power, that system will eventually always fail because at some point the wrong person will be in power. So as much as possible, you want it to be able to be run by morons and not fail. You don't want to have to rely on the right person being in power because someday the wrong person will be.
Yes, and we recently, about a month ago, we had the Powell admission where he sort of said that he doesn't really know what's going to happen as well, which is he has like hundreds analysts working for him as well. So yeah, it's a difficult situation. And Joe, moving on to the stock market. So we're in a situation where, the most of the people got used to buying the dips, and every single time it looks like they're just looking for an opportunity to buy the dip. So what's your view on the valuations? Which way do you think they will normalize? Will it be the fast way or will it be the gradual way? What's your view on the US stock market overall?
Well, when a lot of people are looking at the stock market right now and saying, "Oh, it's overvalued, it's super expensive, it's primed for a crash," and they're comparing it to a lot of historical valuation metrics, where it's like, okay, well, from this valuation metric, whether it's Shiller PE or something else like that, like, oh, the last time it was this overvalued was 1999, and we know how that turned out, the dot-com bubble. Um, and going back through his and saying, okay, well, this valuation metric, the last time it was here was 1929, right before the Great Depression, and so there are a lot of historical similarities between valuations now and valuations right before large and extended crashes and slumps in the market. There are a lot of lost decades in the stock market as well, where you'll go at least 10 years and there won't be a positive return on stocks. So a lot of people are very rightly very concerned about how expensive stocks are. The question you always have to ask though is compared to what? And in that comparison, they're just saying historically. Well, is there anything else that has changed in that amount of time? Well, ever since 2009, the monetary policy decisions and how the dollar is being treated we're in an entirely different environment. So when you look at valuations today versus 99, we're in a different monetary environment. When you look at today versus 1929, we're in a different monetary environment. Um, and so then you look at, okay, well, what about real estate? Okay, yeah, real estate is near all-time highs. What about crypto like Bitcoin? Yep, Bitcoin is near all-time highs. What about gold? Yep, Bitcoin is at all-time, or I'm sorry, gold is at all-time highs. Um, so you start looking at all these things and saying, okay, well, if everything is the most expensive it's ever been compared to dollars, is it really that those things are expensive, or is it that dollar holders are trying to get, they they prefer assets over dollars to a greater extent than they ever have before? So then you say, okay, well, let's measure it versus something that's a little bit more, different or more stable across time. So you look at real estate versus gold. Well, US real estate versus gold is one of the cheapest levels it's ever been before. So priced in gold, real estate's actually pretty cheap right now. What about stocks priced in gold? Stocks priced in gold are at like basically the median level. So when you look at the cost of the S&P 500 in terms of dollars, it's like 6,000 whatever the index level's at. When you price it in ounces of gold, it is basically at the median level. It's not super undervalued. It's definitely not super overvalued. Right in the middle. Um, and so when you start to compare things to other things instead of something like the dollar, which is consistently just losing value, you get a little bit of a different picture that maybe it's just that the dollar is losing value. So then you say, okay, well, let's compare this to other places and assets in other countries or economies where their currency has depreciated really, really quickly. Like let's go to an extreme, something like Venezuela. Well, you look at the PE ratio of the Venezuelan stock exchange, and it's like 6,000 or something like that. Like it just it's ridiculous because you don't want to hold on to dollars no matter what. So you're going to do, or their I think it's the peso or I can't remember what their currency is called. Um, Either way, you don't want to hold on to the Venezuelan currency. You want to get anything else regardless of the cost because at least it won't lose value as fast as the currency. So that drives valuations up because at least it's better than the currency. And you may still not even have a positive return, but it's going to be much better than the currency. So when you see currency devaluation, especially future expectations of that happening more and more, because you see the debt spiral, you see the borrowing, you see the taxing, you see the issues, the future commitments to spending, well, then you're going to be justified in paying higher and higher valuations for assets because at least it's better than the alternative. And I think that's a lot of what's going on right now, that we see extreme valuations, and that's not necessarily a sign that things are about to crash. It could just be a sign that big money is moving into assets more and more because at least it's better than the alternative.
Yes, that definitely makes sense. So, Joe, moving on to a sector where the risk to reward could be more favorable would be the commodities, in my opinion. So, if we look at where the world is going, we need a lot of more minerals, materials, absolutely everything. And if you look at the miners, it takes so long to get the permits, to find everything, to build a mine. So I suppose from that perspective, the mining sector looks quite cheap, even though it performed quite well in the dollar terms. So what would be your view, Joe, on the commodity sector and what commodities you could be personally interested in?
I'm bullish, very bullish on commodities overall. You have to be careful with commodities because they are highly cyclical, and depending on how you invest in commodities, they can be very susceptible to geopolitics. And oh, a new tariff just got slapped on this one country, or a new tariff just got lifted from this country. Many commodities are very concentrated in terms of where they come from. A government decides, hey, we're not going to be exporting this anymore. We're going to be keeping it all for ourselves. So there's a lot of volatility that can happen in the commodity space due to changes like that can happen overnight. And that's part of the reason why they look so cheap right now is because there's that heightened risk that investors are not willing to uh, um, to invest at the higher prices because of that risk that they could overnight become worthless. Um, the other thing about the raw commodity versus like miners, for example, is that with a miner you have to be able to judge two things accurately. Number one, you have to be able to judge the future price of that commodity accurately. So you need to have a really good idea of the current supply, the pace of that supply increasing, the current demand, the future of that demand. Like a couple years ago, everybody thought lithium demand was going to keep on going through the roof. Turned out, oh, all of these EV mandates and green policies, especially in the United States, are going to be going away in a year or two once the administration changes, and lithium demand is going to drop off of a cliff. And so you have to be right about the future supply and demand of the actual commodity, but you also have to value the business as an actual business because it doesn't matter what they have in the ground if they're not a quality business that can cost effectively get it out of the ground and sell it. So investing in miners is a very difficult thing that you have to put a lot of time and research into. That's why I typically say if you're going to do that, it's probably best to just find the biggest index fund, like an ETF, that gets the whole basket of them, because at least then you're going to be exposed to the biggest, most profitable, and most reliable ones. You're not going to get as good of long-term performance as just choosing those individually yourself. But if you try choosing them individually yourself, you might miss out on those anyway. So I typically talk about, if you're going to invest in commodities, especially miners, try just sticking with ETFs. Like, find a big copper mining ETF, find a big uranium mining ETF, and focus on the three or four that seem like they've got the best prospects in the future. Um, and then diversify into those.
What's so attractive to me about the commodity sector right now would be the fact that the big companies are printing cash at the current level, so we don't really need higher prices for them to do really well. And also, Joe, I'm a fan of royalty companies because they have less risk, and of course, the upside would be somewhat capped, but usually the managements are very good because of the nature of the business. And I feel like there are few very good opportunities in that sector. Are you interested in royalty business?
Yeah, royalty businesses tend to do very well in this space. Two questions that you have to answer about a royalty company that you're looking at is A, why are the companies that they are getting the royalties from choosing these arrangements instead of more traditional financing? Um, and making sure that they're, that the royalty company is actually um, going to get what it expects, number one. And then number two is how much of this low risk future income is already priced in. Because markets are future discounting machines. And so let's say like for hypothetically, everybody has a crystal ball that actually works. And we all look at this crystal ball and we can see, okay, the price of gold in 1 year, everybody on Earth knows absolute certainty the price of gold in 1 year is going to be $5,000 an ounce. Well, what will happen is today, the price of gold will shoot up to $4,999.99 an ounce. Because if you know for certain that it's going to be worth $5,000 an ounce in 1 year from now, then you are going to be willing to pay 3,500. You're going to be willing to pay 4,000. You're going to be willing to pay 4,500. You're going to be willing to pay any price up to that amount that you know for certain it will be. And so the amount of certainty of a future value that the market consensus has, the more that future value consensus is brought into the present because there's a profit opportunity there. And so that's why Ray Dalio always says, in order to make money investing, you have to bet against the consensus and be right. So you have to be saying, okay, well, the market consensus is wrong about this. It should be priced higher. And here's why I think that. And then you have to, in the long run, be right about that. So even royalty companies, with the lower risk, that means higher certainty of future revenues. You have to be able to see something like that. Hey, the valuation of this company should probably be higher than it is right now.
Yes, and in the mining sector, without being contrarian, it's very difficult to survive anyways because of its nature as well. So yes, I fully agree. And so Joe, I would like to talk about I suppose portfolio structure in the current environment. So of course, there are different options. It depends who you are, how old you are. But what would be the key points that you would be thinking about while structuring portfolio with everything that we see happening right now and the things that can potentially happen in the next 3 to 5 years?
A couple pieces. So I tend to like to split my portfolio up into three main pillars: real estate, stocks, and reserves. So this is very similar to a very ancient portfolio allocation strategy, but you want some in real estate because it's a limited resource. It cash flows depending on where you are in the world. You get some tax advantages. You get some debt advantages, leverage advantages that you don't get with other asset classes. And if you do it right, then you have somebody else paying down that debt service cost for you, that debt for you, and you are increasing your equity then. And so real estate provides a lot of benefits. Tends to be a little bit more stable in terms of income, again, if you do it right. The second piece that I like is stocks because that's where most of your capital appreciation is going to come from over the long term. You have to be invested in businesses that are producing real profits by producing real products that people want in the real world. And over the long term, that's where most of your wealth creation is going to come from. But most people underallocate to the reserves. And when there are hard times, then most people have to sell their assets in order to survive. And that's why you get crashes because people don't sell at rock bottom prices because they want to. People sell at rock bottom prices because they're forced to. And that's what caused those collapses because everybody has to. So people are fire selling at lower and lower prices because they're forced to. If you have a sufficient pile of reserves, that will never be you. In fact, not only will you be able to survive and hold your assets through those times, you probably will actually be able to buy during those times and be the one that gets to take advantage of those fire sale prices. I like about a 30% allocation to each one of those buckets. And for the reserves, I'm not talking about just cash. That'd be way too much to have in a fiat currency. I like about 20% in gold, 5% in Bitcoin, 5% in your local currency. Um, the reason why is because gold preserves its purchasing power for thousands of years. Um, when you look at how much stuff you can buy with gold for hundreds and thousands of years, the things that you can still measure, like haircuts and three-piece suits and the salaries of an army captain and things that you can track over long periods of time, the prices of those things either get slowly cheaper over time or they stay the same over time. So gold preserves its purchasing power very well over long periods of time. So that's my main savings account. Bitcoin, possible that it becomes used as money in the future. So putting 5% in now gives you an asymmetric bet on gold and fiat currencies fading away and being replaced by Bitcoin. And then 5% in your local currency because that's what your bills are in. So if gold and Bitcoin and stocks and real estate all crash at the same time, you still need some in your local currency in cash so that you can, reserves can serve their function. That leaves you about 10%. And for that, I usually recommend some sort of speculation and or hedging. So a lot of people will take all of their stocks and they'll get tired of index funds, and so they'll start day trading their account and they'll lose 50% of their portfolio within a year or two, and it's very difficult to ever come back from that. So if you have a portion of your money that you set aside for making those little bets on, hey, there's this stock that I heard about, there's this company that I did some research on, that allows you a portion that you're able to practice with and get better with over time. And every once in a while, you do make money with that and move that into the rest of your portfolio, and it keeps everything else safe. So that's the allocation that I like to stick to the most because it gives you a hedge against inflation, gives you a hedge against melt ups, gives you the ability to take advantage of crashes. It's a well-rounded, robust portfolio that can survive and thrive through pretty much any environment.
Yes, it's very interesting, Joe, that you mentioned Bitcoin as part of the safety of your portfolio because most people would think completely opposite. Well, it's a highly speculative asset, but I totally get where you're from. And yes, that's an interesting perspective. And Joe, you never mentioned bonds. So what would be your take on the bond market?
Don't touch it with a 10-foot pole. Bonds are, this is not my quote. I can't remember where I heard it from, but bonds right now are return-free risk. A lot of people say bonds are, risk-free return. I think they're a return-free risk because when you look at the rate of inflation, it's usually equal to or higher than the amount that you're getting paid in interest on those bonds. So at best, your purchasing power stays the same. More than likely, your purchasing power declines a little bit. So you're locking in almost a guaranteed loss, with a very, very slight chance of catastrophic loss if the bond issuer defaults. Now, with a U.S. government bond, the likelihood that the U.S. government defaults is very close to zero, but it's not always zero. U.S. government has defaulted before. They defaulted technically through a timing thing where they missed the payments. And they later made them up. I think it was like a couple of days, but that technically counts as a default. When in 1971, bonds, the U.S. dollar, they were redeemable. They were paid. By law, they were required to pay that back in gold if somebody requested it. If other nations. And the U.S. government defaulted on that debt and said, "No, we will not pay you back what we owe you, what we legally said what we would pay you back." They just said you can keep the paper, and it's happened before as well. The United States did that to its own citizens back in 1934. Um, let's see, I think there was one more example. Anyway, the likelihood is small, but it's never zero. Um, so I don't like bonds because there's some to maybe depending on who the bond issuer is, maybe a lot of risk. The return is usually very low. And the only situation in which I think bonds would be an appropriate part of the portfolio would be for the cash portion. If you have a very large, if you have high net worth, you've got, let's say, $1 or $2 million of that cash portion, that 5% of your portfolio is, let's say $1 or $2 million. Well, that's too much to spread out between multiple banks to try and get FDIC coverage. And so for that, put some of it in money market funds, put some of that in T-bills that are very, very short duration, and ladder those out across maybe 1 year. So you're getting a high yield on your cash, but you're never locking it up for a long period of time. Then that would be a situation where I think government bonds would probably be appropriate. Other than that, it's not a part of my portfolio.
Yes, I fully agree here. It's difficult to imagine with the structure of the current monetary system how bonds would do well over the long term. Yeah. Um, so, Joe, moving back to the dollar just a little bit, what would be your take on dollar being backed by gold or by Bitcoin, and what do you think are the odds of that actually happening with the current political and and social situation?
Yeah, good question. I don't think I've ever I don't think I've ever seen it in history where it happens by choice, by the government's choice. Um, because the government will always benefit more by being able to issue as much new purchasing power to themselves as they want. So when they tap out taxing, then they move to borrowing. When they tap out borrowing, then they move to printing. And I've never seen that just voluntarily be ended because whoever's in power realizes that it benefits them by being able to use that to their own advantage. Um, Now, the times in history where you do see the currency fail and be replaced by gold again, or sometimes silver, most of the time what happens is the inflationary financing just goes through the roof, and the people start using either a different country's money or gold themselves, and the people just don't accept paper anymore. So this happened in the Weimar Republic in Germany. Um, the government tried to replace their failed currency with a new fiat currency, and it was immediately rejected by the people. And the people were already just using gold for themselves as their money. So if the government wanted any purchasing power, it had to pay in gold because that's the only thing that people would accept. So then it had to figure out a way to get gold. And that's when it finally, they finally, started coming out through the other side from their depression. Um, and so I think I think that it's historically speaking, it's very likely that at some point the money around the world moves to something that is a lot more sound and less able to be controlled by governments in terms of its supply. But it doesn't happen quickly. It doesn't happen by government choice. Over long enough time horizon, people get the governments they want and deserve. And if everybody today just decided that they were only going to accept Bitcoin or gold, then the government would have to do that because they wouldn't be able to pay anybody dollars to enforce anything. They would have to get gold or Bitcoin to do that. Um, and the other thing is the reason why I think it'll have take a lot longer, specifically with dollars, is because when you look at old episodes of like hyperinflationary collapses of currencies, they were actually printing money, like physically, like actual paper. And when you do that, all you're doing is increasing supply, and it doesn't really do anything to demand. Today, the way that fiat currencies are increased in supply is through debt. So every dollar that comes into existence is loaned into existence. Well, a loan, at the same time as it creates new supply, it also creates an equal or higher amount of demand for that currency in the future. Because if I loan a dollar into existence, at some point in the future, that dollar has to get paid back, plus a little bit more with interest. So every dollar that comes into new supply and circulation around the world, whether it's a Eurodollar system or in America, means that future demand for dollars is actually higher than it is today. And that's why they have to keep on increasing the supply in order to pay back the larger amount, that was put into supply earlier. Um, and so it kind of keeps, where we do have escalating supply, we also have escalating demand, and that keeps the game going a lot longer.
Hmm, thanks for that, Joe. So, Joe, I'd like to ask this question for the younger audience. So, if we have an individual who's still, I suppose, at the beginning of their well-building path, They have so many choices. They have the Bitcoins, the Nvidias. They could hear us talking about different asset classes. What would your advice be for that person who's not sure what to choose and how to start?
Yeah, good question. For the younger person who's just starting off, I would actually say, I would say focus on income before you focus on investing. Focusing on investing before you have anything to invest is putting the cart before the horse. And it doesn't matter what return you get, whether you pick the best investments in the world, if you don't have a significant amount of money to invest. The vast majority of people's net worth over time comes from their earnings over time, and the every study they've ever done on net worth shows almost a one-to-one correlation with income, meaning the people with the highest net worths also have earned the most money over their lives. So if you're struggling to make ends meet, if you are living paycheck to paycheck, if you can't easily put away 20 to 30% of your income into savings and investing, focus on income first. And keep your expenses the same. Like you need to focus on your expenses. You need a budget. You need to be disciplined. You need to have that long-term delayed gratification. But you can't coupon clip your way to wealth. You've got to increase your income. So whether that's learning new skills so you can get better jobs, or that's learning sales and starting a business, whatever that is, you need to focus on getting your income much higher so that it is easy to put away 20, 30% of your income. Once you're doing that, then I would focus on setting up a diversified portfolio of your 30% reserves, 30% real estate, 30% in stocks. Get that as automated as possible so that from your income, you're just shoveling over into those piles and you don't have to think about it. If you have to think about it and focus on it, you're probably going to be too emotionally invested in it and make incorrect decisions. I would get the allocation set up appropriately first, automate it, and just shovel as much money into it as possible.
Hmm. And Joe, in today's day and age, with access to information, with the internet, a lot of young people they want to do their own thing. They're no longer satisfied by working at the job for 20 years. And you would be a good example of how you build it your own brand, the Heresy Financial. So, what advice would you have for a person who they want to do something on their own? They want to build their own brand, but maybe they still don't really have that much competency or information that
Mhm.
they could share. What would your thoughts be on that?
Um, Two thoughts. Number one, do it. Number two, you need to be able to have something that other people want. Um, I don't think that there's anything wrong with a world where everybody is self-employed. I think that is probably the most prosperous and happy world there is if everybody's self-employed. In fact, looking back at history, that's the majority of human history. Like you think about, peasant farmers and hunter gatherers. It's like technically speaking, every person is self-employed. Like you go out and you get the things that you need to survive. You take care of your family. Most of human history was not like, hey, I'm gonna go do this one task for 8 hours a day and then use the money I get from that in order to fund my life. And everybody is working for these giant corporations. It's a relatively new thing in human history. Nothing necessarily wrong with it. I just don't think it provides the most human satisfaction because there's less autonomy. There's less of a connection between the work and the output. There's less complexity. And so I don't think it provides as much of a rich human experience to be a tiny cog in a giant machine. Um, so I don't think there's anything necessarily wrong with it, but I do think it's a lot more satisfying and personally fulfilling to at least be part of a very small team, or be self-employed or working for yourself, running your own business. Um, Now, the other thing is you have to have something that other people want. Like everybody says, provide value. What that means is You need something that somebody else wants badly enough, they're willing to voluntarily give you some of their money for it. That's all providing value means. And when I, from the time I was in college, in the back of my mind, I knew I wanted to start my own business. I wanted to work for myself. I never had a job that I really liked. And I had many jobs that I like really, really hated. Um, and I tried so many things on the side, little businesses that I tried to start on the side, and most of it was like, I'd see some newsletter or I'd see some video or I'd, go through some course and I'd be like, oh, let me, some self-employment or starting your own business course, and I'd try and do that, but there was no underlying skill set or product that I could create that gave me the ability for that to succeed. The the reason why I was successful starting Heresy Financial is because I actually spent, years as a stockbroker acquiring skills that people actually wanted. They're, skills that were valuable to people. Skills like, teaching people how to invest, communicating, sales, explaining complex economic topics. And once I had a kind of a stack of skills, I was like, hey, I'm currently, I looked at how much money my company was making me and I said, well, if I'm worth this much to them, I'm worth at least that much to myself. And so I left and I started Heresy Financial, and reality hit me in the face. It took me 6 months to make $1, and it took me a year and a half before I was able to make enough just to pay the bills. Um, and I realized that I did have a stack of skills that were valuable to a company. But I also needed then over the next year and a half to learn extra skills to stack on top of that that made those skills valuable to me and to other people. And so I'm a huge fan of burning the bridges. I'm a huge fan of jumping off the cliff and hoping you can figure out how to pull your parachute. That fire under you and knowing that there's nowhere else for you to go, nowhere else for you to turn, will force you to learn what you need to learn. Um, but at the same time, you don't have to feel the sense of urgency of, oh, I'm 24, oh, I'm 29, oh, I'm 35, oh, I'm 40, and I haven't done this yet. It's like, do you have skills and the ability to produce something that people want? If so, then you probably have the ability to start a business for yourself. You'll have to learn how to go find people to sell it to. You'll have to learn sales so you can convince them to buy it from you. You'll have to learn some other things, but you do need something to provide to people that they want. And if you don't even have that base level yet, go work for somebody and get paid to learn that skill, how to provide something people want. And you're getting paid to learn. And so don't look at jobs as, oh, I'm stuck for life in this. I want to go do something else. Jobs are not for earning, jobs are for learning. And if you approach it with that mindset, then yeah, you work one or two or three jobs for a couple of years at a time with the mindset of, hey, I'm going to get out of this so that I can go and start something on my own. It's a fantastic path.
Yes, that's a very interesting job because I had a very similar path. My background was in molecular biology, and I
Hmm.
hated every single day doing that job. And at the time, that's where I started getting involved with investing, with commodities. I've been doing it for 8 years now. But yes, very, very similar situation. And I think it's very important to have emergency savings. In my case,
Yeah.
that would always be at least 1 to 2 years. I know people say 6 to 12 months. For me, it was like 1 to 3 years. And I'm very similar that I like to cut the bridges and I'm done with it. I'm going to do this. So yeah, it's very interesting. So thanks for sharing that.
Mhm.
So these are all the questions I had. Joe, is there anything else that you would like to add? Is there anything we have missed that's important?
No, it was a very good interview. Lots of good questions. Thank you.
Thank you very much, Joe. I really enjoyed the conversation and I hope to have you back.